All right.
Hey there, folks. I'm so glad to be here this morning with Brian. And Brian is our head of our collateral department. He's going to be talking to us about some really big changes that are happening in the condo world right now. And so before we get there, most people don't even understand condos. So let's kind of talk through condos first of all. What is the difference between a warrantable and a non-warrantable condo? What do you see there? I know that's the big talk on the street.
Yeah, so a warrantable condo, what that basically means is a condo that's considered warrantable means that it meets Fannie Mae and or Freddie Mac guidelines, making it eligible for standard conventional financing, which usually results, as you know, in better rate, more favorable terms. A non-warrantable condo may require alternative financing, and typically carries a higher risk for that loan.
Yeah, so we find that a lot. Now, how do you identify warrantable versus non-warrantable condo? I know there's a very specific process when it comes to this, but what are the most common ways of finding that? I know that a condo questionnaire is something we use. Is that the way you identify it?
Yeah, so there's, a lot of different documentation that's looked at. Um, the process to warrant a condo is you're going to review the different condo documents like the budget, insurance, legal documents. The condo questionnaire is definitely a very important piece of that. It's used to gather detailed information about the condo project. So us as a lender can determine whether it meets agency requirements. It helps assess the financial stability, the legal structure, the insurance coverage, and overall risk. So the
I
condo
should,
question, go ahead.
no, I'm sorry. Go ahead. Go ahead. Go ahead.
That kind of questionnaire, the reason that's required is it gives key information about a project that's not always visible in those standard documents, the HOA covenants, the budget. The questionnaire fills in some gaps about litigation, the insurance specifics, occupancy ratios, and then a big one, upcoming assessments.
So that condo questionnaire really is the one that kind of triggers the red flags that are going to ask us to go a little deeper than what we're seeing in the condo docs themselves. Is that right?
Yeah, the condo questionnaire, because the condo docs, they're legal structured documents that they're all kind of the same, have the same information. They give you a picture of the project, but that condo questionnaire is definitely um, gives you some material to dig deeper in, or just to be, to feel comfortable and good with the answers of that.
So what are the most common issues that you're seeing that give red flags are really the litigation pieces and budgetary issues, or what else do you look for in that kind of questionnaire?
Yeah, well, in the condo questionnaire and the condo documents itself, we're looking at the budget, make sure that there's adequate reserves. Currently, typically 10% of the budget should be reserved or allocated for reserves. You're looking at insurance to make sure that the property has proper coverage for hazard, liability, and fidelity. Um, the HOA financials in itself to make sure it's stable with no major deficits, the legal documents, the bylaws, declarations, and restrictions to make sure, Fannie and Freddie make sure that they meet the guidelines the way that they're established. Currently, occupancy, so owner occupied versus investor ratio, that is changing. We'll go over that a little bit later, probably. Litigation, so any ongoing lawsuits, and then special assessments, either current special assessments or planned.
Yeah, those are a lot of different things that you have to look at with condos. Now, why are condos so different than like townhomes? I get that question a lot. I kind of know the answer, but what do you look at from a collateral standpoint when you're dealing with that? Why are they so different?
Just on a basic terms, so the condo is the borrower only owns the building and doesn't own the land. And so they're pretty much, they don't have the responsibility or are not the capabilities to do maintenance and other things on the projects. But a townhome, typically the borrower owns the land and the structure, and they're not as restricted to take care of the properties.
Okay, so you mentioned a full versus a limited review, condo review, and usually, what's the trigger for a full versus limited currently?
Currently, the trigger is single family or primary residence, and then up to 90% LTV.
So if they're
And
putting
then,
10% down and they're going to live in it,
and they're gonna, yep,
you can get a limited review currently.
Currently, yep. And basically, and then just that the property is not an it still requires some review, but yeah, those are the basics for that to make sure.
Okay.
Um, yep.
So, so what would be the biggest difference between a limited review and a full review?
So the biggest difference is the limited review. You're not really looking at the financials or the budget of the HOA. You're just looking at insurance to make sure that they have adequate insurance, making sure that it's not an ineligible property and that there's no critical repairs.
Okay, so that you're not even looking for, I know Fannie Mae, Freddie Mac required a 10%
Yep.
contingency fund. Yeah, on a limited review, you're not even looking for that anymore. Okay.
Nope, you're not looking at that.
Now I hear there's big changes. Well, let's talk about what the full review first. The full review, they're going to be looking for quite a bit more than just the basics of what you said. What does a full review typically entail?
Yeah, so the full review, we kind of talked about it earlier. We're going to look at all the documentation, a
Mhm.
comprehensive analysis of the overall project.
So
So it's
that
going to
includes
require full
reserves.
documentation, the budget, insurance, the questionnaire, the legal documents. Um,
You mentioned investors in there. Talk to me about that. What does that do in the full review?
and the full review currently 50% it has to be 50% owner occupied.
Okay, so 50% owner occupied if it's more than 50% investor. So that would probably be something we would see more in the beach areas. Is that right?
Yeah, yep,
Vacation
absolutely.
areas where the investors are a little heavier in that kind of situation. So that could
Yes.
cause some problems in those areas to go to the full review. Okay.
Yep.
So if it's 51%, that means now all of a sudden it turns into a non-warrantable. Is that what it is?
Yes.
The same thing with the budget. If they don't have that 10% contingency, it goes into a non-warrantable.
Yeah, in general terms, if they don't have that 10% contingency, it goes into non-warrantable. There are some caveats to where if they have a reserve study done, that is very detailed and lays out a requirement that that they may not need that 10%, then that can be used as evidence as well.
Would that be something that you would see in newer condos or in older condos or a mix or
It's a mix, yeah. There's no, reserve studies. It's just when they have determined they want to do them. They're supposed to do them every, I think it is 3 years, or they're preferred to do them that way. If they
understood?
haven't done one within 3 years, I mean.
So a lot of the builders now are starting to build multi-units, and we're seeing a lot more condos than we've seen in areas that are typically not condo heavy. Are there any restrictions when the builder is now just starting to build some of these? Is there anything that would trigger that, make it harder to
Um,
build?
well, new condos typically are going to require a full review.
Okay.
So,
Mhm.
yeah, and just to make sure that they have the proper structure. And then you do have one of the biggest challenges is they have to have a certificate of occupancy, and have occupancy restrictions or current occupancy guidelines. So
Okay.
it's not like a single family residence where we're doing it proposed per plans and specs. With condos, they need to be built.
And I get another question about this sometimes when we're dealing with smaller condos that have like commercial space down below. How does commercial space affect condos?
Commercial space, it don't really. Um, Sorry, I'm gonna have to cut that. Wasn't really prepared for that one.
I wasn't
I
either,
don't
but
look
I
at
just figured I'd ask if it came to
I didn't
mind.
look at the commercial spaces often. We don't run into it that often, so.
Yeah, I know we don't. Okay, well, we'll skip over that for now. So let's
Yep.
talk about the real big thing. This is the big, big, big piece that is extremely important, and this is the changes that are coming. I know there's some massive
Yes.
changes coming August 2nd, and we kind of had to lay the groundwork for what is currently being done so that now we can talk about the changes. So what are some of the big changes that are happening?
All right. So yeah. So earlier this year, Fannie and Freddie actually in joint, which we don't see that too often, but they're aligned in this case, are making pretty big changes to the condo process or condo guidelines. Um, I want to. This is what Fannie had said when they released this. In 2023, we incorporated significant deferred maintenance and unsafe condition, i.e., critical repairs. Requirements for condo projects into the selling guide. Since then, we have seen a correlation between condo projects with underfunded reserves for capital expenditures and those in need of critical repairs. Condo projects with inadequate reserves typically do not have the requisite resources to maintain the physical condition of the project or to fund unexpected operating expenses. As a result, unit owners can experience substantial financial hardship from unexpected special assessments or higher regular assessments or dues, leading to mortgage default or foreclosure. So their revised requirements are intended to improve the financial health of condo projects and promote long-term sustainable homeownership. So I felt like that was important to mention why. That is the why of why Fannie and Freddie are doing this.
That's actually pretty
Um,
good because I know a lot of people buy condos because they simply can't afford, they're buying 150, $200,000 condos because they can't afford to buy a single family somewhere. But keep going.
Yeah, and I think we get lost in that, right? We get lost in, oh, they're making it harder for people to buy these condos. Condos are challenging, or we can't get them approved as easy or things like that. But the goal is because we're trying to protect the borrower.
Hmm.
Um, so the primary updates are the biggest changes coming are the elimination of the limited review. So we talked about the full versus the limited review. So that will be eliminated. There's an increase in reserve requirements from 10% to 15%.
Which there
Excuse
were a
me.
lot of challenges just getting the 10%. So now the 15% is going to make it even harder.
Absolutely.
Okay.
Removal of investor concentration limit. Well, no more of the 50%.
How does that
Expanded.
help or hurt? How does that help or hurt?
That'll hurt. That I mean, that'll help in those those vacation areas where most of them are investors.
So
People
that's
will
good.
be
That's
a
actually a plus then. So that's going
That
to
is a
help
very
with,
good plus. Yes,
okay.
that'll make it so a lot of condo projects that maybe met all the other requirements except for that investor concentration limit will be switched to approved.
Okay. Well, that's good.
And then there's an expansion of the waiver of project reviews for small projects, and then just stronger financial and documentation requirements.
Okay.
So the limited condo reviews, that's effective August 3rd. So any applications taken August 3rd or later.
Okay.
So most projects in that case then are going to require a full review.
Now now you say most, what is the way to get past that?
Well, that would be if they're already approved by Fannie or Freddie and their CPM or CPA,
Well,
or
just
if they're
what
oh, go
is
ahead.
CPM or CPA? What does that mean?
So it's condo project advisor and condo project manager.
So those are websites?
That's their internal websites that are
Okay.
only available to lenders.
Okay.
Um, and So then either that, the lender has already done a full review and has certified the project. Those certifications last for 180 days typically, or that there's a waiver.
Got it. And
So
how would they
then
get a waiver?
I'll cover that here in a
Okay,
little
I'm
bit
sorry. Go ahead.
because that's the updates. So then with the elimination of the limited condo review, most projects are going to have a full review. So it's going to be increased documentation and scrutiny on most transactions.
Mm,
It's going to require a lot more um, assistance from the HOAs, definitely. Um, there's been some industry numbers that have said this will impact 65% of condo loans.
wow.
This particular situation is really, something that I've been researching and trying to make sure we have processes in place once this change takes place, because my data is showing it's going to be between 50 and 60% impact for us.
Mm, that's a lot of
So
condos. 56,
yeah,
50 to 60% are going to have to go through a full review.
potentially, yep, unless they're approved. So I think the impact initially is definitely going to possibly be longer turn times, longer underwriting turn times, and just because of the documentation needed and the full review. Um, they expect after probably at least a couple years that should that should subside because we're going to have hopefully more projects that are meeting requirements and are approved um, and not having to go through that full review.
Right, right. Okay. So what would your counsel be for somebody who's looking to buy a condo at this point in time? What would be something that just kind of stands out for me from all the research that you've done?
I would say, just looking into the HOA, making sure that the HOA is structured well. If and a lot of times the HOA will have some of the documentation online that you can gather, the management companies. So see if they have that information and just look into how well they're managed. And if they you can a lot of times look at the budget numbers and kind of see get an idea of how their financials are.
So when you're looking at the budget numbers, what would be the one place that you would kind of go to? Would that be to the maintenance or to reserves, or where would you
Probably
go?
reserves because that's the biggest, concern looking at. And that's what I was next going to talk about the changes. So the big
Okay.
change going from 10% to 15%.
Okay.
So that effect is going to be effective January 4th, 2027. Because this is such a big change, and as you mentioned, it's been hard for some of the condo projects to meet the 10% reserve requirements.
Mm.
They're giving condo projects more time to start, making the changes now to get up to that 15% requirement.
Okay.
Um,
So that comes in January?
January. Yep.
Wow, that's not far enough, really. That's 6 months.
Truly not. I mean, they released this information in March of this year.
Mhm.
And I don't know if they gave HOAs heads up prior to that or not, but
Mhm.
yeah, this is definitely the biggest change for condo associations themselves, and will likely be the thing that is going to cause projects to be ineligible more often until they are able to catch up and get those reserves in place.
Yeah, that's going to be a tough one because going into the ineligible, non-warrantable condos, now all of a sudden the down payments and interest rates and things like that are higher,
They're
which
going to
make
be higher.
make it a
Yep.
little bit more. But I can understand the whole thing about the assessments. I had a client that had got hit with a $60,000 assessment after they closed on the house, and they literally just about lost their cookies on it because
Yeah.
it's such a big number for them.
Yeah, that is. I mean, that's the biggest thing that Fannie and Freddie just want to make sure that project is financially stable and that the homeowners are not getting hit with, with big assessments that they weren't planning for.
So if you're
The good thing
so
about if with these assessment requirements, it is something that can be fixed. They can't, that's something that they can do, over time. So if a borrower is in a non-warrantable condo situation, that can be a good opportunity for them to, warrant refi into a warrantable condo once that HOA gets those reserve requirements up.
Okay, well, that's good. That's good news. So let's just a couple final parting thoughts. First of all, for the professional realtor out there who is looking to possibly list one of these for a seller, what would you tell them to do as due diligence in order to get set up for representing the condo and the seller?
Well, definitely. I mean, if the management company has the budget and any of the condo documentation available, looking at that because the reserve requirements is one of the easier ones to kind of look at. And just talking to the HOA, making sure that they don't have any critical repairs. And you can find out if they have special assessments in place or planned. Those are some of the easy things that you can probably find out from them that are red flags that could be brought up ahead of time.
Okay, and would that be the same counsel you would give for buyers and sellers?
Absolutely.
Okay, so it sounds like we've hit it all in one little spot there. So thank you so much for joining us today and sharing this. This is extremely valuable information for realtors who are and buyers and sellers who are looking to either sell their condo or buy a condo. And it is a rising market. We're seeing a lot of that. So thank you so much for sharing your time today, and we'll get going from there. Thank you.
All right. Thanks, Chris.